Fund, who will be joining us in a short while to share his thoughts on this particular topic. In fact, let me also take a minute to quickly introduce our next speaker for all of you. Now, he's somebody who feels that debt deserves a permanent place in your client's portfolio. He joined Sundaram Asset Management Company in July 2010, and he comes with more than 2 decades of experience in debt markets, having had research and fund management stints at Deutsche Asset Management, JM Financial Asset Management, and Tata Asset Management prior to joining Sundaram Mutual. He was also awarded Best Fund Manager Debt by Outlook Money in March 2015. So it's going to be interesting, well, both the topic and the speaker, when we're talking about what to expect from debt markets. I'm sure that's, again, another pertinent question on your mind. Let's get the answers from our next speaker, Mr. Dwijendra Srivastava, joining us in a second.
Yeah, hi. Good evening, friends. I'm delighted to speak at this Cafemutual event. I think it has been a pleasure speaking in Cafemutual events, and it gives also you an insight in terms of what is happening in the market. And I have attended most of these events, and I like the way things are presented here and the insight which you get out of it. I think very coveted speakers have spoken on this forum. I think for me, today, sharing with you what is likely to happen in the debt market in just about next 15 minutes is an onerous task, but I will try to stick to it and give you insights in terms of what is likely to happen. To set it up, I think we have to have the context, and I think the context is nothing less difficult and tumultuous than COVID-19, which happened the last year and is still continuing in some form. But the good part is that it is on the decline, and we are seeing lesser number of infections. Particularly in India, we seem to have won over the virus. And what we can kind of see right now is that until there is something else which turns up, which is kind of a tail risk event, we are not likely to see any decline in the growth or decline in the uptick which we are seeing in the near-term cycle. I think from that perspective, what also we should also put in mind is what we have seen in the past year and what is the kind of events which have happened and which is the background for which we are likely to make a forecast for the coming year. I think from that perspective, there were 2 major things which have happened in the global arena. I think most of the economies were rogered by the virus, and the central banks pumped in a huge amount of liquidity. And on the other side, the fiscal balance sheet expanded. I think these 2 major events are the bedrock of what has happened in post-COVID environment, and which alleviated most of the stress which was building up in the economy. And which basically means from a rate perspective, a huge amount of liquidity which is pumped into the system, particularly by the advanced economies. And to put that in context, if you look at it, the G3 assets have ramped up to close to about $23-24 trillion, which is quite huge. And the leader in the pack is ECB, the European Central Bank, at about 8 to 9 trillion, and US is about 8 trillion, and Japan is about 7 trillion. I think that is something which is going to drive the interest rate environment going forward. I think this amount of liquidity in the system is both dangerous as well as benign at this point in time, particularly in a low growth environment. Nominal inflation, even if we see that kind of inflation, which is running at headline inflation of 1 or 2% in the advanced economies, or about 4 or 5% in emerging economies, I think the real interest rates are at negative clip, and at real interest rate being at negative cliff is growth supportive as more and more people go out and spend. I think that is something which is happening, and I think that again is one of the emerging trends which is likely to happen going forward. And when we look at this liquidity growth and inflation framework, I think that is likely to drive the views which we will have going forward. From here, we clip in, we try to forecast what is likely to happen. Now, in a few days back, we have seen the budget was being presented, and the budget, I mean, this is the first budget, according to me, where this particular government has taken growth as the prerogative. And I think post COVID, many things have changed at the end of the government. They've been more positive in many things, and I think they are growth supportive also. What we can see from the budget is that most of the guys have been complaining about the expansionary budget in terms of particularly the debt market has been talking about the onerous supply. When we look at it, I think definitely we will need hand of RBI to take forward the borrowing, which is also evident currently. The post budget, we had seen the yield spiking by almost about 20 basis point over a 2 to 3 day period. But now the yields have clawed back, particularly RBI sending a very strong signal to the market that we are there and we will be taking care of the government borrowing, which is exactly what you should not take too much of heart in terms of RBI coming in and managing the borrowing, because I think that is not the area where you should focus in terms of your deployments in the short run, because the volatility on the long bonds is likely to be quite a bit. I think that is something which you should bear in mind. And if you are a short-term investor and you're putting your monies in long end, I think you better be beware, because that's something which a tactical, which is known as a tactical play, and I think that is best avoided when you are putting your money or allocating your money into say fixed income assets, and particularly in a country like India, which is starved for capital. I think it's very important to understand that volatility in rates is likely to remain. I think that is being taken care of over a period of time, but immediate run, this is likely to be a concern. So that is something which you should bear in mind when you're putting your monies in fixed income. If you are looking for retiral income, I think that is where when you should be looking to put money in the longer end, and a benchmark for that could be your real rate of return. I mean, I think in post-inflation targeting framework, we have seen inflation being seriously being concerned by the MPC, Monetary Policy Committee, and post that we have seen the real return being quite high, and particularly at that same time we have seen the growth being very low. So what the government also has realized that nominal interest rate need to be lower, real interest rate need to be lower. So that is what exactly they are doing. I think they have started realizing that, and they're targeting real interest rates to be much lower than what they were touting them to be at some point in time. And I think that is what is likely to happen going forward. We will see the real returns being lower. I think that will be shortchanging the saver, but at the same time, I think if the growth comes back, this your saving stock overall will rise. If the growth increases, your savings increase as a percentage of GDP. I think that is where I think the government is targeting. I think there's nothing wrong in that. And although the the, the taxation part is something of a worry, because I think the high taxes which are there right now is negative on consumption. I think which is again I think a near-term phenomena which will over a period of time should improve as more sense prevails. From again from a market perspective, when we look at these three things: growth, inflation, and liquidity is what we think is likely to be quite high, because when the printing press, the international printing presses are on, I think that money is likely to flow. That fair share of India is likely to be there. And from that perspective, I think the current liquidity, which is about close to about 7 to 8 lakh odd crores durable liquidity, that is likely to remain in the system. And as RBI winds down the CRR in 2 stages up to May 21, I think that extra space for doing OMOs is available to RBI. So don't doubt RBI in terms of their intervention in the market. I think that is something which is likely to happen going forward. The other place which I think market is not accounting for, not speaking, because I think we get anchored to the most recent past, and that is something which is FPI flows. And I think as forward premiums are pretty high, since the forward premiums are very high, I think the hedging cost is quite high. So probably because of that, we are not seeing much of flows into the debt markets, while on the equity side, which the money comes unhedged and people come for return, pure return. I think that is where we are seeing the flows happening. I think that trend also is likely to persist. You could see immediately, you may not see much of money coming through the FPI, but at some point in time, if the FPI window opens up and some money comes in there, I think that time RBI's need will reduce in the markets. Having said that, I think 12 lakh odd crores is a very high borrowing number, gross borrowing number, and I believe in gross borrowing number. I don't look at the net borrowing number, because there is no 1:1 correspondence in terms of the money which is being borrowed and the net money or the gross money. So I think knowing that RBI has relaxed the HTM limit, knowing that RBI is likely to remain in the markets, and I think that borrowing will definitely need the RBI hand. Having said that, I think the shorter end, whenever you in the 3-year bucket or a 5-year bucket, you see positive real return getting built up. I think that is the time when you should put your monies in the 3-year or 5-year money bucket, because that's where you could probably make money going forward. I think the money printing will keep on happening and the flows will keep on happening. And I think the only thing to define the markets in terms of is that what we can see is priced in. What we can't see is not priced in, and it is very difficult to price it in. So clearly the point is that we have to be ready for such events. I think back to back, rarely we have seen things happening. I think after the global financial crisis, the next thing which struck Indian markets was the taper tantrum. I think that is something which we should bear in mind. I think that most likely we will not be, as a very low probability event that we see post-COVID something else strikes the market. But if that happens, I think we will have a broken market. And that could be deleterious for the markets in terms of the way things are panning. But I think I'm an optimist, and I don't think that is likely to happen. And even the history doesn't speak about it. So we see a very major event coming in once in 100 years, which again, as I said, since it is an event of very low proportion, having an outsized impact, but you can't price it because it's very difficult to price the tail risk. Having said that, I think we expect the markets to remain benign both on the money market side and particularly on the money market side and the long end, because a lot of that has to be managed through the markets. I think sometime in H2, some worries could start coming in because, again, as I told you, the factors which impact the fixed income market, inflation, liquidity, and rates. I think global rates right now are panning towards that side where you don't see them as a worry, and that will cause the money to come into the Indian markets unless the local currency returns in the advanced economies improve. If the local returns in the advanced economies improve, that is the time when you may not see the flows being maintained, and you may see a reversal of flows. But I think I have not seen a better external situation, external asset situation in India than the current momentum. If you look at it, the forex reserves are at 590 billion. You have import cover of almost 18 months. You have a external debt to GDP, external forex reserves to GDP ratio of about 20%. You have external debt to forex reserve ratio of greater than 1. I think this is one of the best times I have been in the markets when I'm seeing such strong external parameters. So from that perspective, even if suppose because normally the situation is from the external side, and if that is likely to happen, we are likely to see a much more gradual increase in interest rates. So I think that's what I have in terms of the view from the forex market. I think my message is very clear that you should remain. I mean, I am very clear that particularly at times of high valuation on the other asset classes, you should be very conscious of asset allocation. Don't veer from your asset allocation. Have your asset allocation, because you, allocating too much into a single asset could be deleterious. So I think that's about it. And thanks a lot, friends.
कहते हैं अगर लड़की को घर का काम नहीं आता तो उसे कोई अच्छा लड़का नहीं मिलेगा, लेकिन मैं